Every trader I have ever known has done the same thing. They open a chart, they find a level, they draw a line, and then they wonder why the market walks right through it, like it was never there. Here is something the textbooks will never tell you. Lines don't stop price. People do. Fear does. Greed does. Memory does. And if you keep treating support and resistance as geometry, as static horizontal lines, you will keep losing money to a market that operates on something far more powerful than geometry. It operates on human beings. In this video, I'm going to show you what support and resistance actually are. Not what the courses teach you, what the market teaches you, after it has taken your money enough times. Before we are done, I will show you the exact pattern that large funds use at every major level, and how to recognize it before it destroys your position. You have been thinking about support and resistance backwards. Every time you draw a line on a chart, you are not drawing a line. You are marking a moment in time when thousands of human beings made a decision. Some bought, some sold, some held on too long, some got stopped out on the way down. That moment became a memory. And memory, collective market memory, is what creates a level. This is not technical analysis. This is psychology. This is the accumulated emotional weight of every trader who ever touched that price, compressed into a single horizontal line. And there is a specific way to measure how alive that memory is. I will get to that in a moment. When you understand this, you stop asking, will this level hold? You start asking something far more useful. How many people remember this level, and what do they feel about it? That question changes everything. Let me show you how this works in practice. When a stock rises sharply and then reverses, what actually happened? People who bought lower took their profit. People who had shorted earlier felt vindicated and pressed their position. Traders who missed the initial move decided the stock was too high, too fast, and bet against it. Price did not stop because of a lie. Price stopped because of human beings making decisions based on memory, pain, and expectation. The same logic applies when price falls back to a previous low. Traders remember that level. Some made money buying there before. Some missed the original move and want a second chance. Some were stopped out and want to get back in. When price returns, all of those people wake up. Their emotions activate, and the market responds.
You now understand why levels exist. The next question is why some levels hold and some dissolve without warning. Here is the first truth you must carry with you. A level is only as strong as the memory behind it, and memory has two measurable fingerprints. The first is volume. When a level forms on heavy volume, many participants were involved. Many people have an emotional stake at that price. When price returns, all of those people wake up. The level has teeth. But when a level forms on thin, quiet volume, few participants, little emotional connection when price returns, there is no crowd to respond. The level dissolves, not because the chart was wrong, because there was no memory behind it. The second fingerprint is time. As months and years pass, the original participants rotate out of their positions. The crowd that created that level 3 years ago is largely gone. The level may still appear on your chart, but ask yourself, is this level living on original memory? Or is it surviving only because traders who came later have collectively decided it matters? The answer to that question changes your conviction and your position size. And there is a third element that most traders never consider: what happens when a level does not hold. This is where most people get destroyed. That is coming next. Before I show you the false break pattern, the exact mechanism large funds use to harvest retail stops at every major level, I want you to understand role reversal, because without it, the false break makes no sense. When price breaks below a support level, everyone who bought at that level is now underwater. They are sitting in a losing position. They are in pain, and they are waiting sometimes for weeks for price to return to their entry so they can exit without a loss. When price does return from below, those same people sell. Their desire to escape pain becomes supply. Former support becomes resistance, not because of some mysterious market law, because human beings are wired to avoid loss. Now imagine you are a large fund. You know where the retail stops are placed. You know where the obvious support levels are. You know that just below every well-known support level sits a cluster of stop-loss orders and trapped sellers waiting to exit. So you drive price into that level hard. With volume, it looks like a breakdown. Retail traders panic. Stops get triggered. Weak hands are shaken out. And then the reversal. Price snaps back above the level. Clean, fast. The false break is complete. This is what I call the springboard move. This is not a failure of support and resistance theory. This is confirmation of it. The level was real enough to be worth targeting, and once the trapped hands were cleared, the original memory of value reasserted itself. The move that follows is often the most powerful move of the entire sequence because it is now free of all that overhead selling pressure. You now understand why levels form, how to measure their strength, and how they get manipulated. What remains is how to act on all of this at the exact moment of the trade. Here is my rule. I never committed fully until the market confirmed my thesis with its own behavior. When price approaches a level, I do not place my order at the line and walk away. I observe, I probe, I ask the market questions. Is volume declining on the approach, meaning the move is running out of energy before it even reaches the level? Or is volume expanding, meaning aggressive participants are pressing hard into it? Is price hesitating at the level tight, indecisive candles that show genuine uncertainty? Or is it slicing through previous minor levels with momentum, showing no respect for anything in its path? The market will tell you whether the level is alive, but only if you are watching the film, not the photograph. If you are working from a static chart with static lines drawn hours before the open, you are already behind. You are reacting to a fixed image of something that is constantly in motion. Reading support and resistance correctly is not about where you draw the line. It is about how price behaves as it approaches and what that behavior tells you about the crowd standing behind it. I survived as long as I did in these markets, not because I was smarter, but because I was willing to wait, and I was willing to be wrong in small amounts before I was right in large ones. Every line you draw is a hypothesis about collective human emotion. Every trade you place at a level is a bet on how that crowd will behave. There is only one quality that separates the trader who survives from the one who does not. Not the right indicator, not a better setup, not a faster data feed. Discipline. I lost more money than most men earn in a lifetime, not because my analysis was wrong, but because I entered before confirmation. Because I sized too large out of emotion. Because I was impatient with a market that owes me absolutely nothing. The market is indifferent to your needs, your schedule, your account balance, your feelings. Accept that fully, without reservation, and you become a different kind of trader. You stop demanding the market perform for you. You start watching for the moments when it naturally aligns with your thesis. And when those moments arrive, you press hard. If you have ever been in a trade where the level broke and you did not understand why, leave a comment below. Tell me the setup. I want to hear it. The crowd has patterns. Because human psychology does not change.